The world economy is facing its most severe challenge of the post-war period. Economic activity, financial markets, and private sector confidence are all collapsing. The decline in economic activity because of the pandemic lockdown is unprecedented in history. Its impact on the real or productive sectors of the economy is worse than what was witnessed in the aftermath of the 2008 Lehman crisis. The collapse may appear similar in both cases, but the reality is different. The 2008 economic crisis was a slow burn, and events, including macroeconomic developments, played out over months, while this time it is a sudden dip in economic activity, after the lockdowns were announced in the different countries. Will the present downturn prove to be sharp but relatively brief, with a snapback of economic activity, once the pandemic curve is flattened? Or is the stage set for a deep and protracted global recession? The outcome depends on the trajectory of the pandemic, the responses from policymakers, and whether these are sufficient to contain the damage, while rebuilding consumer and business confidence. In any event, the combined public health and economic crisis makes a rapid recovery less likely. Demand has been ravaged, there are extensive disruptions to manufacturing supply chains, and a financial crisis is unfolding simultaneously. Unlike the 2008 to 2009 crisis that was triggered by liquidity shortages in financial markets, the crisis now unfolding involves more fundamental solvency issues for many firms and industries beyond finance. Another key difference is the worldwide nature of this shock. During and in the immediate aftermath of the global financial crisis, a few emerging markets such as China and India continue to register high growth, pulling the world economy along. This time, no economy is immune, eliminating the option of an export-driven recovery for any country. The economic collapse has increased deflationary and financial risks in the advanced economies. Commodity exporters have also been hit hard, with commodity prices spiraling downward as demand evaporates and oil prices plunging even more as Saudi Arabia and Russia flood the market. Regarding the oil crisis, in 2008 to 2009 there was a demand shock. This current crisis looks likely to have a bigger impact, partly because there is a lot of uncertainty still around, and partly because it is both a demand and supply problem. In fact, global oil consumption is expected to witness its biggest fall in history, hurt by a temporary ban on travel, factory shutdowns and other measures to contain the virus. The fall in oil demand could easily outstrip the loss of almost 1 million barrels a day during the 2008-2009 recession, Bloomberg reported. And the industry will likely see some real pain inflicted if prices remain in the $30 a barrel range. The U.S. economy has come to a virtual standstill, with a large share of the services sector shutting down, industrial activity being disrupted, and a red-hot labor market giving way, in the space of a few weeks, to a dramatic surge in unemployment. In the last 2 weeks in March, almost 10 million people applied for unemployment benefits. Such a sharp and staggering increase has never been seen before, not even at the peak of the global financial crisis in 2009. The US has responded with a series of fiscal and monetary stimulus measures, which will help mitigate the immediate fallout from the crisis. The Federal Reserve said it would unleash an additional $2.3 trillion in lending, as restrictions on activity to help contain the pandemic had forced many businesses to close and put about 95% of Americans on some form of lockdown. Still, to alleviate the longer-term damage from this economic sudden stop, further targeted stimulus measures are needed, especially to protect economically vulnerable households and small businesses. Europe and Japan, which were facing economic stresses even before the pandemic, are likely to suffer substantial declines in output and increases in unemployment. France, Germany, and the UK face historic recessions as all indicators of activity and trade tumble. In some of these countries, social safety nets that are stronger than those in the US will mitigate the impact of the crisis. EU leaders agreed a €500 billion economic support package for members of the bloc hit hardest by the lockdown measures. But the path to recovery will be long and difficult. China's economy seems to be getting restarted, at least to a limited extent, and despite the restrained monetary and fiscal policy responses to date. Key economic indicators such as industrial output, retail sales, and fixed asset investment contracted sharply in the first 2 months of the year, but there are signs that the contraction might have bottomed out. In some respects, China's command economy is built to better withstand such massive shocks compared to market economies. Its government can aggressively marshal national resources beyond the limits of traditional macroeconomic tools by directly supporting enterprises and banks. But the economy is hardly out of the woods yet, especially with unemployment rising, domestic and external demand likely to remain weak, and given the risks of a second wave of infection. Other emerging market economies are heading for a traumatic period. Many have decrepit healthcare systems, congested urban population centers, and high levels of poverty, leaving little room for maneuver between controlling the pandemic and sliding into economic disaster. Making matters worse, some of these economies are also having to cope with sudden stops of capital inflows, depreciating currencies, and a lack of external demand for their exports. Others face formidable debt loads that are only growing harder to finance. Kristalina Georgieva, the managing director of the International Monetary Fund, said that emerging markets and developing countries would be the hardest hit, requiring hundreds of billions of dollars in foreign aid. Just 3 months ago, we expected positive per capita income growth in over 160 of our member countries in 2020, she said. Today, that number has been turned on its head. We now project that over 170 countries will experience negative per capita income growth this year. In fact, we anticipate the worst economic fallout since the Great Depression, she added. Georgieva said also that if the pandemic eased in the second half of 2020, the IMF expected to see a partial recovery next year. But she cautioned that the situation could also worsen because there is tremendous uncertainty about the outlook. It could get worse depending on many variable factors, including the duration of the pandemic. The Indian government, which was already grappling with a sharp growth slowdown, has put the economy on lockdown, but faces both a health crisis and an economic crisis. Brazil's limited pandemic response so far may sustain economic activity in the short run. But its financial markets and currency have tumbled, reflecting the likelihood of an eventual lockdown. The economic and financial carnage wrought by the pandemic could leave deep scars on the world economy for a long time to come. Central banks, at least, are stepping up to the challenge. The Fed has taken measures to bolster U.S. financial markets through asset purchases and by providing dollar liquidity to many foreign central banks. The European Central Bank has stated that there are no limits to our commitment to the euro, while announcing massive purchases of government and corporate bonds and other assets. The Bank of England is set to directly finance government spending. Even some emerging market central banks, such as the Reserve Bank of India, are considering quantitative easing operations. Such measures will keep financial markets from freezing up, but will not by themselves offset the fall in consumer demand or stimulate investment. But banks, especially the European ones which have been struggling to boost profits at a time in an ultra-low interest rate environment, are nevertheless feeling the heat. They are bracing for further interest rate cuts and loan defaults. Experts are also flagging a possible sovereign debt default by Italy, which is in a state of lockdown to contain the spread of the virus. European banks are holding more than 446 billion euro of sovereign and private Italian debt, according to Bloomberg. To avoid a systemic failure, during the 2008 financial crisis, the US government and Federal Reserve bailed out banks who secured the mortgages. But it is more complex than that because there are the banks, and then there are all of those that are beyond banks. It's a bigger crisis, and we have less effective monetary policy because interest rates declines have reached their limits, and just by buying financial assets by the central bank, and buying the normal financial assets won't work. With both conventional and unconventional monetary policy tools already stretched to the limit, fiscal policy will have to do more of the heavy lifting. Well-targeted fiscal measures can soften the blow on consumers and businesses, especially small and medium enterprises that tend to have minimal buffers, thereby helping sustain employment and demand. In these desperate times, this option ought to be exercised by governments that face low borrowing costs, even if they already have high levels of public debt. Low and middle-income countries with inadequate health systems, where the pandemic could be catastrophic, need support from the international community, potentially including concessionary debt relief. The inability of national governments to come together even at such a critical time to forge a common front against the pandemic highlights a dangerous fracturing of international cooperation. This is further damaging business and consumer confidence, which are already in freefall. The need of the hour is honest and transparent information sharing by national leaders, coupled with aggressive steps to contain the epidemic, extensive stimulus to limit the economic fallout, and a carefully calibrated strategy to restart economic activity before too long. China was the first country to experience the full force of the disease, with confirmed active cases at over 60,000 by mid-February. European countries such as Italy, Spain, and France are now in acute phases of the epidemic, followed by the United States, where the number of active cases is growing rapidly. In many emerging market and developing economies, the epidemic appears to be just beginning. But the Chinese recovery, albeit limited, is encouraging, suggesting that containment measures can succeed in controlling the epidemic and pave the way for a resumption of economic activity. But there is huge uncertainty about the future path of the pandemic, and a resurgence of its spread in China and other countries cannot be ruled out. I hope you enjoyed this video, and if you still have any questions, write them in a comment below. See you in the next video.